All right, good morning, everyone. Let's do a quick sound check. Let me know if you can hear me and you can see my chart. All right, Alan, Anthony, Dino, Kevin, Paul, Robert, Sally, Solomon, Steve. Fantastic. So to begin, first thing we're going to do is go through the disclaimer, right? Trading is risky. Please don't trade with funds that we can't afford to lose. Talk to your broker and understand the risks involved with trading. This is a live presentation, and so you're able to ask questions. It's not a pre-recorded event. Understand everything that you're seeing. If you have any questions, please ask them there in the chat box. All right, so to get right in it, let me bring up my chart. All right, so to begin, what we're going to do is I'm going to bring up the chart, which is the E-mini S&P. I have the news indicator here listed, so we know exactly news that will occur today. The news indicator can be downloaded from DayTradeToWin.com. We also have the TradeScalper, the Atlas line, the at the open. All of these methods are based off of price action. Some of you may already have the TradeScalper or the Atlas line. For those of you who don't, I focus on price action, and I focus on whether or not the market is volatile. I focus on the type of targets and the stops, which are adaptive, and I try to understand what I'm seeing as a bigger picture. And we really try not to jump in to the market just looks like it's going to go up or looks like it's going to go down. I really like to focus on the type of orders that exist. So the first thing we're going to do is look at the ATR, the average true range down here. I use a setting of 4, and for those of you who don't know, even though I do have a lot of videos, over 400 videos currently, or 500 videos I think, on the Day Trade to Win blog, there's also a videos page, and there's also the YouTube channel where I post most of the videos and commentary. I speak about the ATR because it's important to understand the conditions that exist. So whatever trade, whether it's based off of what I teach or anything that you may be doing, always understand if the market is slow or it's fast. And that way we can dictate the stops and the targets. You don't always have to have the same stop on every trade if the market is slow, or if the market is fast, we have to adjust. So this ATR here is important because it tells me the current conditions being 3.5 points, 3.6. I'm just rounding down to the nearest quarter point. So 3.5 points would be the move that I expect the market to go in, either up or down. So the signal to go short, 32.2275 here on the TradeScalper, indicates that the direction and the price, the exact specific entry price to enter short, and then I'd like to see the market move this distance, 3.5 points. Now you don't always have to take the full ATR, the full value of 1 times the ATR. You can be a little bit conservative. You can say I'm just taking 3 points or 3.25. So that's the goal, looking at the current conditions and dictating the stops, the targets, and the trade management. Anyone have any questions for me? All right. So for example, this trade here at 32.2275, the distance that I can expect the market to go either up or down is based off of this value. So that way you have a very specific target that you can take advantage of instead of guessing where the market's going to go. So if I put here a ruler, you can see the distance the market went. It's actually going more than that. Is expected to be equal to the ATR, and it's actually done when it happens. So this is when it happens. The signal occurred. On the next candle, we're filled right here. When this candle comes up, you're filled. And so about 3 points is my expectation. So that's really the goal when you look at trading with a specific target and having a stop. Usually the stops that I like to have are a little bit larger than the ATR, just a little bit, because I need to stay in the trade. I don't want to get knocked out of the trade unnecessarily. So it's It doesn't have to be complicated, in my opinion. I think it has to just focus on the current conditions and then using price action to get me into the market. Now the next thing we're going to do is we're going to look at the best times to trade, because it's not always the best time to trade right as the market opens or right as the market's about to close, or possibly overnight when the market's very slow, although we've had very good volatility overnight. One of the things that I like to do is be very cautious as soon as the market opens, not to be in the trade. So this specific trade right here that you're seeing at 32.2275 is a little bit risky, even though it worked, it was successful. I think that when you start off the day right as the bell rings and then initiating a trade, there could be a lot of volatility, a lot of chaos. You could have the market swing up and then swing down and swing up and swing down very fast and very hard. And for those reasons, I think that it's best to hold off and not be in a signal or in a trade right as the market opens. So in this example, there was a signal right as the market opens. It's a little bit riskier. It worked out. It was successful. But I think it presents a different element of risk, because we're doing it at a time where the market's opening up, the cash market is opening up, and there's a lot of activity that occurs right at that moment. 5-10 minutes later, I think you're okay. It's just right as the bell rings that we have to be careful with. Now you see some other signals here, back here, to go short and to go long. The signals are very straightforward, and I try to make this as easy as possible. The course explains to you how the signals are generated, the TradeScalper signals, but it also includes training videos and a live training session. So we have the next training session coming up on Tuesday of the upcoming week for the TradeScalper users. We have a live training just for the TradeScalper users for that day. Okay, so take a look at this signal here, 32.27 to go short. We're going short. Look at the ATR, about a 1.5, 0.75. That's my expectation. The market moved a total of 4. Even so, if you waited until the market came back, it still went more than the ATR of a 1.5, 2 points. So you have plenty of room here in order to take a trade and take the profit. Even if you want to be a little more conservative, I think that's a good idea. If you go back here a little bit further, this is a long over here. This long trade over here at about 8:49 Eastern Standard Time. Same idea. From here to here, 3 points. If you look at the ATR, it was only a 1.5. So even if you wanted a 1.25, a 1.5, the market moved that distance. Now sometimes you get into a trade. Let's talk about the things that could go wrong as well. Not just, all the trades that are winners and the benefits of using the TradeScalper, but how do you manage a situation where it doesn't go your way, or there could be a market that's flip-flopping and not making the profit that you want. So what I like to do in those situations is cover myself with a grouping of protection. So one of the stops that I teach is time, a time-based stop. So if you entered into a trade and you're waiting for the profit, you don't have a stop, it hasn't hit your catastrophic stop yet, but you're waiting for a profit and it's taking too long. The market's not doing anything, it's flip-flopping. At that point, you should be out of the trade. And so my suggestion is having a time limit, a time-based stop, an element of time that will get you out of the trade, whether it be a break even or a small loss or a small win. Holding on to signals for, let's say, an hour is not the way to go. If the market doesn't move directly in your favor as soon as you enter, the longer you hold on to a position, the worse off you are. So that's something that's important to understand, an element of time. The other thing is using proof, right? So if you enter into the trade and there's proof or evidence that the market's not going in your favor, and that could be based off of, for example, a pivotal stop. That could be an example of a prove it stop. So these are things that are taught, proof, that the market's going in not going in your direction. Maybe there's a signal that goes in the opposite direction as well, proof that you shouldn't be in that trade. So if you have something that gives you evidence that you shouldn't be long, I would say get out of the trade. It could be a loss, but you should be out of the trade, because what hurts most traders is the large losses, not the small ones, but the large losses. So if you're able to get out of the trade at a smaller loss because you have evidence or proof, I would say get out of the trade. The TradeScalper is included with the mentorship class. So for those of you who are asking, the next mentorship class begins July 22nd, and all of the software is included: the Atlas line, the TradeScalper, the roadmap, the At the Open, with lifetime licenses as well. So the TradeScalper can be purchased separately with a 6-month license or a lifetime, but it could also it is also included with the mentorship program with lifetime licenses as well. And you can check out DayTradeToWin.com, the mentorship page, for those of you who are interested in or asking. All right, now the next signal that we have, whether it be a long signal or a short signal, we're going to look at the ATR. It says 3.41, so it's a rounding down 3.25 points, round down to the nearest quarter point, so 3.25 points. So I know immediately whether I should be in this type of risk, 3.25 points. I know if I should stay out if the market's too volatile or too slow, and I know what my stop is. So all these things are known in advance, especially when it comes to the entries as well. This is taught. The entries are also known in advance. So I know if I am to go long or short, there's a reason for that long, short, the profit, and the stop. And I'm using currently a 1-minute chart, but the TradeScalper can really be used on multiple markets, not just the, bring this up here, not just the 1-minute chart, but also the 2-range chart, or the 5-range chart, or even a volatility chart. So for example, let me bring up here another chart. I'll add the Atlas line as well, which I have here, and I'll add, for example, a 2-range chart. So I'll come here to data series, and I'll use a value here of a range, and currently I have here a 4, and the ATR is a little bit more volatile, so I'll keep this at 4. When the market's a little bit slower or more normal, a 2-range chart is fine. Remember, a 2-range chart says 2 ticks on every candle before a new candle begins. A 4-range chart is 4 ticks. So I'm going to apply that, and I'm also going to, so I have the Atlas line in this chart, and I'm also going to add the TradeScalper as well. So we can see the signals for the TradeScalper and the Atlas line on this 4-range chart. So I'll come here to indicators. I'll come here to the TradeScalper. I added it, and we can remove the bar timer. Bar timer is used more on a minute chart or a time-based chart, not a range chart. And we don't really need to use the ATR because every candle is exactly the same. So here I have the 4-range chart waiting for a signal to appear, and I have here the 1-minute chart. Now when you first start looking at trading, if you're looking at scalping, it's easier to do one trade at a time, not to continually try to buy and sell every few minutes. Wait for a signal. We typically know in advance when the signal is going to occur, and then we initiate a buy or a sell. If you try to do too many markets at the same time or too many contracts and buying and selling both at the same time, I think that's very difficult to do. And I also think that you don't have to trade 10 or 20 times a day to be successful. I think that if you limit yourself to 4 or 5 trades per day, and if you're up for the day, then you should stop. I don't think that trading 10, 20 times, still trying and trying and trying, I don't think that's the right way to go. So in my opinion, trade better, trade less, trade more accurately, not just consistently enter the market, because one of the positions that you could be in, as far as a position that exists, is also out. So you can be in the market as a position, and you can be out of the market. So one of the positions, just to remember, is also not being in a trade. It's also considered a position. Now the next thing that we're going to discuss here is what these candles are trying to tell me. As a trader, my focus is price action. I avoid moving averages, and I avoid MACDs and stochastics and momentum. And the reason why I avoid those type of indicators is because they can be manipulated historically with changing the values. So if I came over here and I looked at, for example, a moving average here, right? So we'll come down here to a simple moving average, SMA, right here. So if you looked at an SMA, you have here a value that you can input that exists. So if you're using a specific chart and you do back testing and historical testing, you could say, well, the simple moving average of 14 works in this time period, or of 20. Or if I use this type of chart, it only works with a 200 moving average. So the problem that exists when you have a value attached to an indicator is that it could be adjusted historically to curve fit the data. And that's what I'm trying to avoid. I'm not trying to come up with values that curve fit historical data. As a trader, I need to have something that's universal, that will always work regardless if the market is slow or fast, or regardless of the chart that I use. So the problem with most indicators, whether it be a volume moving average or an EMA or a MACD, they all have values that you input as a trader, and then you try to figure out whether or not today I should be using 10 or 5 or 30 or 50 or 100. And that's not the way to go, because what worked in history or historically doesn't necessarily work into the future using these set values here. So that's really the problem, curve fitting data and values with indicators. And if you see a lot of programs and software that creates very high accuracy, the problem with that is that it's probably curve fitted data where they find a value that's very specific to historical that makes it look good, but it will never work into the future. So just something to consider, that we avoid at DayTradeToWin, using these conventional indicators and using values to them. I just like to use price action when trading. Does that make sense to anyone? Anyone have any questions on that? If you want to learn more about trading, visit DayTradeToWin.com. Subscribe to the DayTradeToWin YouTube channel, the next mentorship class where we cover all of these methods with lifetime licenses for the software.